All right, everybody, this is John Canali Correa. We're here with another show and great information for you. Today's topic is become a buyer, okay? A home buyer, become a home buyer. And I've been announcing this the last couple of days. And actually, no, last week I've announced it. And I'm going to be throwing you some hard truth. And I think you need to tune in and listen up, whether you're already a homeowner or you're thinking to buying one soon or in the future. This is the time where you want to listen up and take some notes and learn from the experts that can take you to that direction you're looking for. Okay. So I'm going to start by sharing my screen here and introducing myself. Give me 1 second. So I am with Around Town Properties, baby, and the real estate talk show starts right now. I have here with me today a special guest. I'd like to introduce you to Jerome Pemberton. Forgive me if I can't pronounce it correctly, but Jerome Pemberton, how you doing?
I'm doing great. Thank you so much, John, for having me on the show. I'm honored. Thank you so much.
It is a pleasure. I know you are an expert in the field of home purchasing. You've been with our team for a long time. Tell me a little bit about yourself, Jerome. How did you start in the real estate business?
Oh, thanks. Starting a business over 20 years ago. I used to be a school teacher, actually a school teacher and a track coach. So I was coaching kids and then I stopped coaching, and then I was in the mortgage business for 10 years in New Jersey, and ended up coming to Houston because got transferred from a company a while ago called National City Mortgage. So I was always in the community, always helping people from knew nothing about buying a house, didn't even have a idea to believe that they can purchase a house. A lot of clients that had barely nothing in low income clients, and then we did in the community. It was always involved, and I came to Houston. Eventually, became on the realtor side, which gave me more insight. I'm able to talk to the client and talk to them about buying a house and how easy it is, and what you need to do to stay focused on. Because a lender, I tell people, the lender is only looking at basically numbers. If you give them the numbers they want to see, they're going to give you an approval. If it's from the credit report, they want to look at numbers. Their debt to income ratio is numbers. Where you want to buy, it's all based off of your numbers if you could afford to buy in that area. So it's interesting in our industry, but that's how I started, from teaching kids to teaching communities about understanding how the numbers work for them to be a homeowner and have a better life.
And that's really beautiful because, when you become a real estate agent, a lot of people relate to being a salesperson, but at the end of the day, I know a lot of our colleagues, including you and I, we know we share a different kind of passion. We educate, we like educating. And at the end of the day, we are here to help the community. That's the ultimate goal. And from all the colleagues that I've been around with, I know we share a lot in common as far as the longevity in the industry. I also started as a mortgage broker. Back then, you could be called a mortgage broker, right? Now it's a loan originator. They changed a little bit of that terminology, but and then becoming a real estate afterwards. Kind of locked in a lot of opportunities for ourselves and those that worked with us. So that is something, for those that are listening in right now. Look, man, we, like you hear from Jerome, he started from just being a kids educator, and that's what, 20 years ago, Jerome?
That was 20 years ago. I'm still educating. I'm more effective in the community than I am in the classroom teaching the kids, because we're teaching the kids, I say the children and the parents, that this is something that, homeownership, everybody needs a place to stay, right? We need to,
Absolutely.
have family get a place to stay. And I think as long as we, as real estate professionals like we are, we understand the industry and we understand family finances. We understand more than what people are, they so-called doing research online, John.
Right. I completely agree with it, with this. And we share that passion, and we're here to touch the community. And this video is being shared in my Facebook community, but also being shared on YouTube. So if you find us on my channel, John Canali Correa, please subscribe. There's going to be a show every week and more content as we go. And like I said before, we're here to bring you the information that sometimes it takes you a little bit more of education or initiative to find, but I'm bringing it to your screen. So tuned in. We have a lot to share with you today. There's going to be some harsh truth that we are going to throw at you. I don't mean to be offensive. I think everybody shares a little bit of these issues, including myself. And just stay in and listen up. I think if anything, you're going to come out here a little bit better off than you were maybe 5 minutes ago when you got in. Okay. Just I'm going to also moving forward, since we're going to be talking about financing a home today. I need to share with you that I'm also part of Model Mortgage Grace Mark. My NMLS number is 1984859. Okay. And over here in this house, everybody has equal opportunity. All right, so big subject here, Jerome, debt to income. And let me stop here for a second and say this. All right, so 2 ways you can buy a house today. One, you have a boatload of cash in your bank account and you go and purchase a house. The other way is you have an employment, you have income, and you know what you're doing with that income. That's another subject to talk about here in a second. Without it, you can't buy a house. That's the darn truth. Okay, but even if you did have a boatload of cash in your pocket, nowadays rates being so low, there is just really no point of using your capital to buy a home or anything else for that matter. There's always a way for you to offset interest rates by properly investing your cash. So tune in. This is for you that have a boatload of cash in your pocket, or the person that doesn't, the person that doesn't have a dime. And I'll show you a few ways here how you can purchase a home this year. So debt to income here, Jerome. Oh my God. All right. So I don't think anybody knows, or if they do know or heard of before, I don't think they know how important it is for you to obtain financing. You know, I have a lot of friends in the industry, friends that learned from me that they're real careful what they finance, and you know, and they're carefully paying attention to what their debt to income is, right? So I gotta say this: whenever you're financing a home, a bank is looking at your debt to income. That's one of the primary things that they're going to be looking at. So I brought this picture over to you, and Jerome, just to check, can you see the screenshot?
Yes.
Yes. Okay. Perfect. Yeah. Last time I had a little bit of an issue. I thought I was sharing the screen, but I wasn't. You know, only after the show I kind of realized that portion of the show I didn't have the screen being shared. So I apologize for those that wanted to visualize what I had in mind for you, but I couldn't. So my apologies for that. But this time around, I will check with my special guest. He'll tell me, he'll be my guide here, make sure I'm sharing this thing properly. Okay, so what is front end DTI? So debt to income, the monthly housing expense. All right. So basically, your existing expenses, such as a current loan or property taxes or insurance you pay in your current home, and HOA fees that you pay in your existing home. So For the sake of an example, this is for somebody that already owns their home. Okay, folks that don't own a home yet. There's a different formula for the front end DTI. I'm going to show you in a second. Okay. So basically, the banks are looking at what are your current DTI percentage. Okay. So it's a ratio between your expenses and your income. All right. So banks created this sort of risk management guideline. Okay, that tells you what they feel comfortable with these ratios. Okay, so a person that has a high percentage of front end debt to income or high percentage of expenses versus your income, that person is deemed too risky. All right. And I'll give you an example here, real quick. Um, Front end ratio, you can see your monthly income, $6,000. Your mortgage payment, your existing mortgage payment, $1,100. House insurance, HOA, and property taxes. So your total monthly expense in the front end is $1,500. Okay. And then you divide $1,500 by your income, you come up with 25%. So that means that you're using 25% of your income on these expenses as of right now. Okay, your front end, your existing expenses are 25%. Then we'll go into your back end debt to income. Now, banks are also looking at that back end debt to income. All right. Now, the back end debt to income is what we're going to propose. Whenever you decide to purchase a new home, we're going to propose your new debt to income. In other words, we're going to figure it out that after you purchase your new home, what is your debt to income at that point? Okay. So now your housing expenses, that would be your new home or a combination of homes you already have, plus your other debts, like your auto loans, your credit cards, or student loans. All right. So now banks are looking at your back end ratio, and they also set a limit to what they feel is less riskier. Okay. So I have loans, and Jerome knows a whole lot about this, that the bank is allowing you to use up to 50% of your income towards your house and your current expenses. Should we really consider doing that? Let's touch base on that in a little bit. But using 50% of your income towards housing and your other debts, it's really not that recommended. But for the banks, they consider that you can live with 50% of the rest of your income. So is it the right thing to do? I'm not quite sure, but I'm going to give you an example here of what it looks like on your back end. So your monthly income of $6,000 is the same when you're looking at your percentage on your front end debt to income. Your mortgage payment is $1,100. Your house insurance $100. Your HOA fees is $100. Your property taxes is $200, and it totals to $1,500 as your front end. Your car payment is $300. Your credit card is $50. Your student loans is $150, totaling $500 monthly payments that you do to your car payment, to your credit cards and student loans. Total of $2,000. To make it quite simple, you divide that by your income. Now your total expenses are 33% against your income. That number sounds a little bit more comfortable, wouldn't you say, Jerome?
Yes, that number is comfortable. And one of the things that people don't realize is that if you can expound on income that the bank can use, because there's a lot of clients that have other income coming in, they'll say, and I'm sure you hear this all the time, I make this amount, but the bank, there's some income that the bank can't consider.
Absolutely. So it is, like I said, for the lender who is about to give you a whole load of cash towards that house, they know they're putting the house on something secure, right? A home is still a secure place to put your money in, right? It's a safe place to put your money in. So the bank knows that they will have that return in case you can't make the payments, right? But they also want to know that you have the ability of repayment. So the lesser your debt to income is, the more likely the bank is going to feel comfortable in giving you the money. Okay, so if you're planning to purchase a home, okay, and this year, sometime maybe after the summertime or just before the summer, okay, should you purchase a new car and bring your car auto payment higher when the bank is going to be looking at your percentage ratio and considering you for a loan? Should you? So that is a question we're going to be answering here pretty soon. Jerome, um, what is the number one reason somebody can't finance a home? Like the very number one reason, in your
This
opinion?
is what you're talking about. It's the debt. It's the debt. It's
Is your
usually
debt.
a car payment, or it's the debt. It's usually a car payment or a student loan.
Right. How many
Probably
times
the
did you
number one,
have
number two.
how many times did you have a client of yours that in the middle of a home purchase decided to purchase a new car?
A lot of times they said they had to have it. I was like, all right, so you're telling me you couldn't call me, we could have figured out a way. You could have purchased that car after you bought the house because you're not going to sleep and you and your kids are not going to sleep in the car. There's too
Exactly.
many other strategies out there to get a car covered. But you can't, I mean, I guess you could, but I don't think anybody wants to sleep in a car with their kids.
No. And did that person purchase the house? And if you can remember, how many of those
No,
actually were able to buy
most of them,
that?
once they bought the car, no, usually after they purchased that car, the chances I would say that we were able to turn that around is probably less than 5% of the
Right.
time.
Right. Well, so
But the scenario, you see this all the time.
right. So what we see in this situation, we see it in our industry a whole lot of times, is people not being cautious. Let me unscreen this. We're going to chat a little bit. I'm going to take the screen off. I'm just trying to find my mouse here real quick. Oh, there you go. Let's stop sharing. All right. So what we see a whole lot is poor management of their income. I mean, very poor management. Okay, guys, listen, I don't mean to offend you. We we are not born knowing how to use our income. Period. I didn't know how to. I had to learn this, and believe me, I failed so many times before I actually learned something. Thankfully, my wife stepped up and took care of my expenses and managed my income a little bit better. She's the one that actually taught me a whole lot. Without her, I think I would have been broke right now, right? But but look, poor management of your income is literally the number one reason why you don't own a house right now. Or if you own a house, it is the number one reason why you haven't purchased another one or you can't purchase another one. So managing your income is absolutely the most important thing that you can do, not just for purchasing a house. Come on, let's be real here.
Right.
Not just for purchasing a house. Some of you have kids and they're soon going to go to college. Some of you, your kids are still young and you haven't gotten to their teenage years where they're asking for a car, or some of you don't have saved up um, enough cash for rainy days in case you lose a job. So poor management of income is definitely going to get you nowhere when it comes to purchasing a house. And there's a couple of tips here, that I learned along the years. And just last week, I was actually in a training myself, and this coach came to me and told me, um, pay yourself first. That was his number one rule. And I learned this also from my brother-in-law, Alex. Jerome knows who he is. Pay yourself first. You got to create a formula that you are, especially if you're self-employed. If you're employed, is a little bit different tactic. But if you're self-employed, guys, okay, you gotta have a formula. Sometimes multiple accounts is what is necessary, and have the discipline to whatever money you take from that paycheck, you distribute it in the right manner. Uh, Pay your taxes. Well, pay yourself first, pay your taxes, and then pay your expenses, and then pay your savings. Pay yourself first, and savings can be two different things, by the way. What do you have to add on that, Jerome? What do you do with your expenses, my friend?
Well, I think everybody has to figure out their patterns, their spending patterns. And like what you were saying, and my wife, for example, is one that puts money away. We had to figure out what works for us within the family of these boxes you're talking about, is
Yeah.
creating the box, right? It could be different boxes, different accounts, and then having a conversation and saying, and which way do we want to go? And then when money comes in, and start disciplining yourself and put them in different boxes. And there's multiple reasons why you need to do it, depending on what you're trying to achieve. And then here's the thing: when I talk about managing boxes, John, it's that if the goal is to go on vacation, that's one box. That still doesn't stop you from putting money in the savings, the rainy day fund, or whatever fund you want to call it. It just comes down to discipline. And you got to realize with yourself if you're really disciplined or not. My wife is more disciplined of putting money in those boxes. I'm not.
Yeah, you gotta
But
be
I'm okay with
honest
that.
with
She just
yourself.
gave me, I'm not a little kid. Got to be honest with yourself, right? So she gave me $100 today. It's just blow. We call that for our box, that's blow money. So I can do whatever I want with this $100. If I want, whatever I want to do with the $100, I'm able to do that. Am I a
That
little kid? No, but it's just that I'm disciplined to know that she's more disciplined of putting money in those boxes.
Right, right. And at the end of the day, you gotta pay attention to your own goals too, Like you have to set those goals ahead of your habits, ahead of your wants. We're human beings, and sometimes we're out of mercy of our stubbornness. We act compulsively, and we just want to have what everyone else already seems like they have, and then you just buy. All of a sudden, you have
Mhm.
multiple shoes showing up at your house, and then later in the week, you figured out, oh my God, I think I overdid it. I bought too much. All for the sake of wearing a nice shoe or a name brand T-shirt, but yet you live in a condo and you're driving a BMW, what I mean, and you're renting. Is that working for you? How's that working for you? But I'm not gonna question. We shouldn't question what makes you happy. Sometimes, I mean, I know a group of people that, what, they don't believe in buying a house. They believe of spending all their monies right now before they die. It's okay, Then do you,
Right, it is okay.
it is okay. Then do you, your heart is in the right place. If you believe in what you're doing is right for you, okay? But sometimes, you find yourself in the end of the spectrum where, I know, Jerome, you probably experienced the same thing, your friends from high school, and now you look back and you see the ones that were successful and the ones that are just okay being the same way they were, 30, 40 years ago. Look, I am sorry for you, but if you chose to be that way, you know, nothing we can do. But it's never too late to realize certain things and grow up, put your pants on, and go to work, right? And going to work is not simply dressing up in the morning and go, punch your hours in, and your daily job, I mean, it's something that you've been doing for 5 years now. There's really nothing exciting but to you just show up and getting paid and leaving. I mean, there's a whole lot of people like that.
Mhm.
Okay. And unfortunately, sometimes they get trapped in that scenario. And I'm going to tell you a story, Jerome. One time, after I came out of the mortgage industry, 2009, the economy crashed. I had to leave my mortgage broker's license just because there was no money in it anymore. And I stayed a whole year in 2009 just with my wife and our firstborn. So it was a good opportunity for me to relax and come out of the mortgage business. Then an opportunity came for me to just join Ace Hardware team, which today I feel like it was a great home building material college, so to speak, for me, because I learned everything about a home through that stage of my life. But it was a $12 an hour. I went from $40 an hour to like $12 an hour in the course of a year. But I went in as a student, like Mark Cuban says, always you should think you're a student, right? And I learned a whole lot. But at one point, I felt myself trapped. I can see that the routine was trapping me and furthering my career, and not necessarily in real estate because I was obviously getting out of the mortgage business, and I probably crucified the mortgage business for a little while because it killed me. I put too much into it and then lost everything, and it wasn't even my fault. I was doing the right thing. I wasn't cheating the system like a lot of people were. You know what I'm saying? So um, I never thought I was going to come back into real estate. But I did feel like I wasn't going to be making enough money to be frugal. Sometimes we do like to be frugal. Sometimes we dream big and we want to have the best cars, the best houses. And I was trapped. And then I talked to my dad, Jerome. I talked to my dad, and he's like, John, that if you stay, you're probably never going to get out. If you don't make a move in your life right now, and I was in my 30s or mid 30s, whatever that was, 30s. And if you stay, you're never going to get out. And next thing you know, you're just the employee of the month at Home Depot. You know what I'm saying? And there's nothing wrong with that. There's pride in that. Some people just you know see themselves within a career in an organization. It gives you health insurance, 401k, and for a lot of people to retire under those terms is really good. But I did see more potential in myself here, Jerome, and I'm like, you know what? I can do more. I can do more for the community. I love real estate. I need to do something to make a difference in my life. So all it took me is that click for me to realize what I have to do to get back on my feet and move forward to a better lifestyle. But again, a lot of people, maybe if they haven't, had that click yet, maybe this is opportunity. If you listen in right now, this is that opportunity. You have to listen to yourself sometimes, and it tells you a whole lot. It tells you when it's time for you to move. And if you don't move, you're likely going to look back and regret that you haven't done anything about it when that click came. Okay. So I'm very fortunate for that. Jerome, do you have anything to share in that aspect?
That is a great transition, John. That's probably the number one reason why I ended up in real estate was because, when people say the American dream is to purchase a home, I looked at it as you have families out there, praying and saying that they want to own a home, and they really don't get the correct information to realize how easy it is if you have the right information and have the right people to go to so they can fix their situation. Meaning that most people that we talk to, I can fix their situation in probably about 10 minutes based off of what you was trying to show people of what the debt to income ratio is. And when you break it down of buying a home is, and people are probably going to bash me about this or whatever, which is okay, right? I tell them buying a house is probably just as easy as purchasing a car if you understood the numbers that the bank is going to qualify you for and why they qualify you.
Absolutely.
And so I can say that with, and I know why they're calling. I'm talking about, right? And we probably get, and I don't tell a lot of people this, we probably get about 3,000 inquiries a year, right? And I hear the same problems over and over. And John, you hear the same problems over and over and over again. And from a number standpoint, I know what it takes to fix the situation and what product to put that family in. And we're not talking about how much the family makes, because I get people that call us to make $2, $3, $4, $500,000 a year, right? And they're looking for a mortgage product, which is just a tool to purchase the house. It's a product, right? And so it's if you have the credit score and if you understand the game of credit, that is a whole totally different game to itself, right? But if a client needs to make more money, and that's John, that's what you was describing. You were describing as I had to do what I had to do for my family. We get this. Rough times happen. Bad things happen to great people. We get that. People lose family. We get all of that. But realistically, it doesn't matter what you've gone through. If you understand the rules, right, in our industry, you can purchase a house if you get in touch with the right person and they give you the right information, so you know what to do as a husband, a wife, a child, or whatever. What you need to do to build yourself on paper, so when they come to you, John, that you can give them a loan. And so it's not hard. So if you lose your job, you can go get another job, right?
Absolutely. And
if you
Jerome,
have
there's
a high car payment, you can always.
And there's a lot of hustles that you can do. There's a lot of hustles.
So there's no excuse that you can't solve your problem unless you physically can't work, right? Because you got a mental capacity or you got an ailment, anybody's situation. How many people come to us that just went through a divorce and they still buy another house? How many people had just lost a job last week and they're interviewing for another job and still in the process of the house being built and we still get them funded? How many people, how many people that have $100,000 and $200,000 of student loans, right, was turned down by multiple banks? They call us, and I was like, no, you got to go to this particular problems because we understand debt to income ratios and what they need to do. Now, if they don't take our advice, I think they're not taking sound wisdom. It's not that we're the average agent out there closing less than 8 transactions a year. Not like you're an average loan officer. We deal with a high volume of people, and people come to us because of our expertise based off of our numbers. You understand what I'm saying? People don't know what really do. I'm not, they don't know. But when people are coming to us, they're not telling friends they called us, right? And that we're fixing their situation and they're getting this house. That's the things that people can't research, the stuff we really do. And when people come to us, it's always so hard to buy a house. I'm telling them, no, buying a house is one of the easiest things if you know what you're supposed to do and you can fix your situation. But I don't think people want to really have that conversation, John, that the high car payment, we could always get rid of a car, right? And to get our debt to income ratio, and those are choices. Those are decisions, right?
You have to
get what we want in life.
Right.
Right. And what I'm saying, people don't want to hear the truth about that. We get, people come to us with 2 high car payments. They get rid of the car to go buy a house. Every day they call us about that.
Absolutely.
And then when the person says, oh, I don't want to do that, $600, $700, $900 car payment. And I look at it, I was like, okay, you just don't want to buy a house, and it's okay. Like you don't want to qualify for more to get the house that you want. So you go home and tell your kid you couldn't buy a house because you didn't want to get rid of the car or the truck.
That's right.
But that's not a responsibility. But you can't say you can't get a loan. What I tell people this every day, John, don't ever go back and say you couldn't qualify for something, because that's not true.
That is not true. And honestly, I come across this situation all the time. Why are you not buying a house right now? And I'm talking to a tenant, right? Or somebody that, wants to rent a house. And I'm like, why are you not buying something? And this is the first point of contact. Oh, because my credit ain't good. And I'm like, how do you know? Have you talked to an expert? And that's the subject I wanted to also touch is, and I think you mentioned some things in that same line, which is, look, if you're afraid and you not know what to do, consult an expert. Just do a little bit of research to whom you're actually consulting. Find out if they have any ratings, their reputation, any feedback from others. The best one is a referral from another person that had a success story. That's the best one. The referrals are really important, okay, guys? They can go bad too, but look for an expert's opinion. Consult that person. Sometimes I know you can get embarrassed to maybe talk to your brothers or your parents or a friend. Just out of the blue, man, you're an adult. You know what I'm saying? Just go online, search somebody local that seems like he's helping a lot of people, and then call him. He's going to be more than happy to talk to you. So and again, going back into savings, guys, we have a ton of applications available here on your phone that can help you manage your income and put the money in the right boxes for you to accomplish your goals. Now, see, Jerome, I also manage my DTI, and then off the top of my head, I already know. You know what? Right now, I got too much stuff in my DTI right now. My DTI percentage is high. I mean, if I had to refinance my house or purchase another, I had to consider eliminating some debt first before I can even consider, refinancing my house. So, but that's the sort of mentality that you got to have. Not a lot of people think about debt to income, but they think about their debt. So if you're thinking of buying a house this year, you need to be considering, okay, what to do with that cash you have, if any. Okay. Now, before you go paying a lot of your debt off, consult an agent, consult a loan originator. Let them guide you to what to pay off. Sometimes, and I'm going to give you a few examples here, sometimes paying off debt can ruin your credit for the next couple of weeks, or months, right? So that you need to be aware of.
And timing of paying it is important too.
Timing of payment is important. Very good. So, but mostly important, there is a product, a loan product out there, whether you are employed or self-employed, and I'm going to be sharing that with you today. But the important part is having income coming in, stable income coming in, knowing for yourself that whether you can afford or you cannot afford a home. And then if you can afford a home, buy within your means. Do not exaggerate. Do not use the full potential of acquisition you have through that lender you just ran into. In other words, using the full 50% of your income towards a home. Why? Why are you going to do that? Why? Okay, you shouldn't do that. But anyways, and on the subject of debt to income, brings up a little bit of an issue that we all have. And Jerome, I know you know a whole lot about that because you work for many years and helping those get out of their current situation with their credit. So we're going to talk about credit repair, okay? And I'm going to throw in here a couple of things. Okay, Jerome, what are the let's simplify here for everybody, okay?
Mhm.
what are the maybe 3 or 4 ways you can repair credit?
Number one, you can take the time and educate yourself, and you can start working on your credit yourself to see what you can get removed off your credit by yourself. There's a lot of number two, you can use multiple companies because you may have to go through several companies to pay an expert and to get the negative items off your credit. And then, John, I want to make sure we're clear about this. People's philosophies about credit is all over the place, especially on the internet.
Absolutely.
My definition is I want to get everything negative off my credit, right? And if whatever it costs me to do that, I'm going to do it. Not just paying a collection off, for example, or a charge off, if that was on my credit, right? I'm talking about having it off my credit. So when the lender or any lender looks at my credit report, they don't know what my past looks like at all. That's a different approach versus a Band-Aid approach of I'm just going to get my credit fixed so I can buy a house. Does that make sense?
That makes a lot of sense.
Process, because I got my credit fixed, the benefit is I'm going to probably have to bring less money to the closing table. John will be able to get me qualified with more products. My score is going to be higher, but the first thing I'm going to do about credit repair is I'm not going to look at my credit score, John. I want to get every negative late payment, any account. I want to get it off my credit first. Then I'll come back to you, John, and say, okay, now how do I need to build my credit to get the loan that you're recommending me, John, that I need to get for my family? Does that make sense? Because now I got to build it. Can I do all at the same time? Yes. But my main approach in credit restoration is to get all the negative, the repos, the charge off, the late payments. But that also comes back to what you said before, is managing the boxes, John. If you can't manage the boxes first, and look at your income, there's no reason to even start talking about restoring your credit.
Absolutely. And let me touch on something here real quick. Okay, so listen, guys, credit is a reflection to how you're responsible with your expenses, period. Okay, so why is credit so important? Well, if you want to take advantage, if you have a whole lot of cash and I know some baby boomers that they never used credit before, their credit doesn't look good at all because they don't need it and they never used it before. They can care less about it. But if you are in the millennial category, yes, you're going to want to worry about your credit. One, because it's not smart to use your capital to purchase things. You can borrow for basically free nowadays, and use your capital, like I was saying before, to offset those interests you're paying on your loans and make some money out of your capital that you have. Right. But so credit is very important, and it reflects how responsible you are with your bills. You see, when you take, and this is time for us to tell some darn truth here, okay? When you borrow money from somebody, whether it is a friend or whether it is your parent or whether it is a bank, you are shook a hand and you took a responsibility. It is time for you to be responsible. And you need to be responsible enough to not take a loan if you don't think you're going to be able to repay it back. We see it a whole lot of times, people just taking for granted and borrowing money from banks and not ever having the intent to pay it back. That to me is stealing money. You're stealing money from somebody. I know, the few times that I lended money to somebody, I never seen the color of that money back. I mean, honestly, have a little bit of decency and honor. Honor yourself and your name. You shook a hand. You need to pay it back. So credit is a reflection to who you are. But again, don't get me wrong. You might be just turning it off right now because you got offended. I get it. But I do understand that sometimes you go through some real hardship that wasn't really your fault. Or was it? Not sure. But a lot of people did go through the pandemic or recessions, or they lost their jobs, and what they thought they were able to pay back, they couldn't. And but then those of us that you know what? As soon as I get my money back, I'm going to clear my name. Back in the days, they were sharks out there that would come and get the money from you. If they couldn't, they would just kill you. You know what I mean? That used to happen back in the days and might still happening today, cartels and whatnot. You know what I mean? So, but, these poor banks, they're not going to send a shark over to your house to get their money. They're going to maybe try to take you to court or hire a collection company that's buzzing on your phone all the time or send you emails and letters and hunting for their money. Well, they have every right to do that, man. You borrow money and you didn't pay back. Okay, so let me take it back here a little bit. Again, I am sorry for those that went through hardship. I've been in that position a few times in my life, and I know what it's like. Sometimes you just can't, and then you prioritize your money and you pay the roof over your head. And it's funny because Jerome, sometimes the banks look at that as well. I mean, I know landlords will look at that. Look, man, they kick the bucket on everything else, but they still got their car to go to work, and they have a home, a roof over their head. So they're paying rent on time at least. Because you stop paying that, you get kicked out, and then you're done, right? And then you're homeless at that point. So sometimes we look at that as well. But man, look, clear your name is the right way to go. And that's what Jerome was saying. And then it starts by you taking the initiative. A lot of these credit repairs can be done on your own. On your own. And there are like actually laws out there that protect you in that regard. In other words, if the debt is older than 7 years, you should be asking them to be removed from your credit. Or if it hasn't touched in some states, this is not all states, and I forget exactly what's the terminology or the status is, but after 3 years, if that debt hasn't touched, you can claim that it's been abandoned, and then you can clear it out of your credit. But there's a lot of things that you can be doing yourself, okay? But then there are those of us that, we've a little bit ignorant about the information, and you consult the loan originator or you consult your real estate agent, and he's going to guide you. Maybe perhaps there is a company out there that is going to do the work for you. But now you have to be really careful with that. Jerome can tell you this as well. You have to be really careful who you hire to repair your credit, because one, there is a company that's going to dispute, and nothing but dispute, your old collections. Okay, basically what they're doing, I'll tell you right now, what they're doing is the same thing you can do. Okay, which is claim against your credit bureaus that account is not yours. Basically, you say this is not mine. Okay, you're not being totally honest here. I know you're not. Okay, but you're saying this is not mine. However, there is a gap in the system here, a gap in the system that tells the creditor that you have 30 days to respond whenever there is a dispute on that credit line. Okay, if they don't respond within 30 days, then it must be removed from your credit history. Okay, well, you know what, these banks are they're tax savvy, they're super fast, they're lightning speed computers, and they have the staff. So in most cases they respond right away, and you miss that opportunity. But what this dispute company do is they are repetitive. They keep on overloading the system as much as they can until that bank misses that one window, and then it's removed from your credit. So that's one way to do it. You pay a company to do that, or you can do it yourself by just logging into your TransUnion or Experian.com account and doing it yourself. Okay? Is it effective? Well, it is effective, but it takes longer. It takes longer for you to completely get things out of there. And while you are in a dispute stage, you cannot finance a home. The banks are going to be looking at it and say, while you're disputing, we can't finance your home. You must delete that dispute. Okay? So that's something long term for you. The other way you can repair your credit is paying off your debt. But that you have to be careful. And I always say there are some old wounds that if you touch, it bleeds again. And if your score is somewhat financeable and you start paying debt right away, what happens is it kind of it slows down. You're pulling credit to view that score, and you're paying off. That action is known to kind of degrade your score for a little bit until then it gets back up. And a lot of people I see, Jerome can relate to this. A lot of people have um, collections. They clear those collections, but they have nothing else that is positive in their credit history. A auto loan gives you points, but not a lot at all. It's an installment, so it doesn't test your ability and your responsibility to pay back your loans. So a credit card, unfortunately, none of us want to have one. A credit card is considered a revolving account, meaning it fluctuates. Your balances go up and down, and sometimes it goes too high where you can't pay enough. And your GTI, remember your GTI, the amount of income you have and the expenses you have go too high, then your scores drop. You know what I'm saying? So those things, there's a science behind it. So a revolving account is where the bureau the most to kind of figure out your ability and your responsibility to pay your debt back. Okay, so consult again an agent like Jerome and I to figure out what's the best action to take. Paying off it too early or paying an account that you can just easily dispute or delete can actually harm you. And if you don't have anything positive, there are credit card companies out there. I think it was Premier something that will give you a credit, even if your credit is shot. They'll give you $500 at the highest interest APR possible, but they will give you a credit card and test your skills to manage $500. Okay. So, Jerome, share with me a few tips here to get your credit to a higher score.
One of the tips, and I just want to, that we should be monitoring our credit. I advise people to use myfico.com because if one is going to educate the client, you have about 30 different FICO scores out there, right? Versus going to Credit Karma and everything. And once in your life, you should go to the company that issues out scores to 90% of the banks. You may not know what scoring model they're purchasing, but once in your life, at least see all of your scores, and that's myfico.com. One of the easiest ways, and this goes back to increasing your credit score, first thing you have to do is to find out organically what is on your credit report. I'm talking about getting your organic reports from Equifax, TransUnion, and Experian. So you can, not the computer stuff.
You can get one free a year, right? You can get one credit report a year.
Organic report. Yeah, probably. I'm not real big, John, about the free thing. I'm more about getting the situation fixed. If you got to pay to get it fixed, like you just got to pay to get it fixed, right?
And that's a subject
and so
that I wanted
if you
to
got
talk
to
to
pay again, and I'm talking about getting it fixed, right? So I'm telling you, go to myFICO. That's the company that we order. You order your credit reports from. Forget about Credit Karma. Forget about all these other sites that's offering it. Go pay the money. Go get the monitor and go to myfico.com and pay, right? And get the monitoring system and learn all your FICO scores. But then when it comes down to raising your credit score for a specific industry, if it's for credit cards, if it's for auto, if it's for your house, right? Because this is our show. Go see what your mortgage FICO scores are, the estimated scores. It's not going to be the actual, right?
Right.
And then from there, let's see what's on the report. So if John goes to you and you have an idea about your credit, right? And he says, look, this collection, and I'm just using it for FHA, and you got to count whatever the 0.5% or whatever for the payment. That client now understands, if I get this and dispute this off my credit, this is more house that I can qualify for. And at the same time, John, you can run a simulator and say, oh, I mean, this may increase your credit score of this potential points. To me, that's one of the easiest ways to fix your situation to get possible points is to have you guys do a simulation after that client tells you what their situation is, to get that type of console. Because sometimes on the simulation for you to purchase a mortgage, you might see in the system, in your algorithm, by doing a simulation that they have a point potential of lowering some credit cards, right? Balances, and getting some stuff off their credit where they might have enough and knowing exactly what they need to do to earn
20 points, I guess. You got cut off a little bit there, Jerome. And now you're going to come back strong, making noise. Hello? Well, while Jerome takes a little bit to come
client
back
situation.
Here, oh, there he is.
By doing that and getting advice from you guys, the lender.
Right. Jerome, give me a second there. You went off a little bit. I think your internet kind of cut off a little bit, but let me go back here on something. Do you see what it's on the screen there now?
Yes.
Yes. Okay. So basically, when I pull credit, the company I use for credit reporting, Credit Plus, they give you a potential score improvement ratio here. As you can see, experience, there's potential to earning 5 points, TransUnion potential over 55. Right. So this credit card company offers you an algorithm. It offers you an intelligent AI system that kind of gives you a recommendation to what you can do. Now, this service is paid for. I think I don't remember exactly how much it is, but you can literally click that button more and ask for it to run it real time, and it gives you kind of like, okay, if you do this, you can get this many points. In other words, pay this credit card down to below 30% of your limit, or pay off this credit collection over here, and so on. All right. So a lot of these things we can do it our own. You know, if you have an expert that knows what they're doing, they can guide you with that themselves, to be honest with you. But this is usually works as well. So you have the dispute process you can do yourself or hire somebody, or you have systems like this. It's kind of going to give you more of a detailed method of doing it. But let me go over a couple of things here with you, Jerome. Look, the next screen here. This is an example of sort of what we want to be looking at. Okay. We want to be looking at, that person has a auto loan. He pays $112 a month. That's fine. Their credit cards is not a full. You see, he's using about 30% of the limit. Okay, so I mean, I know it's a lot of information on the screen for those of you that's following us right now, and I don't really have maybe you can see my arrow. I'm not quite sure, but
I can.
You can? Okay, so they can also. All right, so you can see here that you have the minimum payment and you have your actual balance, but this is your credit limit right here. Okay, so that means, this is how we want to be looking at. We want to look at these. These are healthy. You see revolving right here? These are healthy credit lines. They're actually boosting your credit. And I'm going to come back. It's the same person over here. This is why she's got the 622, the 647. You know what I mean? It's because she does have some positive things going on for this person, okay? But let me show you something else. This same person has collections, okay? And it's funny because normally they don't put the full account number in these. I had to erase all the account numbers. Obviously, I can't disclose who this person is. And you can't not find out who this person is through what I'm showing you. But you can see here that you probably had a ripple here through a federal credit union. That person owes a bank, a credit union, $36,000. It's a car they probably took, okay? And this is the history before the car was taken. So if you think about it, took what, maybe 90 plus days here, 790 days for them to take a car away from you. Okay. I mean, they probably saw things going bad for you a long ways before they took your car. Yep. Jerome?
So let me say this, those last three, can you hear me?
Yes.
John, can you hear me?
Yes, sir.
Those last three slides is so critical. It's so critical for me to help a client because this is the information that is needed to fix the credit, to fix their situation, because it gives me, it's almost like going to the doctor and I can look at the x-ray
That's absolutely right.
and figure out what is their patterns. And so that's what I'm saying with credit restoration. If I have this data from you first, then I go to the surgeon that's the credit person, I can guide them and tell them what I need them to fix.
Right. And I got a point to make here on that as well. And this is an important point. I'm going to go back to slides here. Okay. So this person's middle score is now 622. I can get a loan for that person. There is a home loan that I can give him because with just the score, okay? Obviously, we prefer that
Right.
it's much higher than that. I prefer a 640 and above. It'll be easy on your expert, but we can get a loan for you at a 622. And I'm going to show you a few tricks that we have on for you today. But here's a problem. I'm going to go back into debt to income. In order for the bank to ignore all these collections here, you know what they do? They're going to accumulate. If anything above, if you accumulated debt that you owe, that you're not paying for, it's in collection, is more than $2,000, then they take 5% of that amount and make it into a payment. So if I put all these here together, we're looking at about almost $1,000, $1,200 a month that needs to be calculated into your debt to income, your debt to income. So what is going to happen? Because of these collections here, let's just say without it, with your current income, you qualify for $200,000. Now, whenever we look at this collection here and we use the 5% formula on your, we're going to ignore that you have collections, that you have been not paying these people at all, but we're going to assume that you have every intention in your soul to pay them back. And we're going to assume that you're going to be paying 5% of your money towards these people. So what happens then? You were qualified for 200, but then whenever I do the formula to calculate the 5% out of these debts that you owe, then you no longer qualify for 200,000. You qualify for 100,000. You can't find in major markets like Houston, Miami, California. Look, you wouldn't be able to buy a house anymore. You can't find a house for $100,000 like that. At least that your wife is going to like. You know what I'm saying? It's real hard. It's real hard. So you take a big hit by having this in your credit line. But let me give you another example. What if you wanted to refinance your house and cash out because you found yourself in a situation where you don't have a lot of savings, and the only thing that can save you, and believe me, a lot of times what saved someone, it was the equity in their home. You know what I mean? And that's why it's so important to buy a house. You know what I mean? So what if you wanted to refinance a house and now you can't because you have these problems here, and this 5% of all your debt in collection is going to not allow you to refinance your house and get out of the situation. And this is what we see, a snowball effect, and most people lose their homes after, because they're now trapped and they're hard to get out from. So then you have to consult. You need to be smart and consult one of us and start working on your credit before you foresee that problem coming. It's hard sometimes, but stay connected. Stay connected. Stay always connected to people that can help you. But furthermore, I have another scenario here. Somebody that have the potential to get 55 points in experience, 36 in TransUnion, and 46. Man, there's a lot of things that we can clean up on this guy. And it looks like even their current credit, the one that's supposed to be good, he still has it. Look at that. He had some trouble periods here. Look at that, some trouble periods. And we're looking at 2 cars in their name. And a lot of times, you want to be nice to your family members, and then you finance a car for your niece, and you finance a car for your brother, and at the end of the day, this person's scenario here, she can't finance it because the majority of the late payments are being done by someone else other than you. Look what this person did to this person's credit. They're both in the same boat here. I mean, it looks like they're both in trouble a little bit. But now this Capital One is back on track. It's being paid on time. But Federal Credit Union isn't, and it's still harming her. So, but anyways, she wants to refinance their house, or he wants to refinance their house. But now they have 2 car loans, 2 payments, that all it's doing is shrinking your income. Oh, but it's my daughter's car. It's my sister's car. I'm not the one paying for it. I mean, there are ways out of that, Jerome. You got to show a 12-month history of someone else's payment towards that loan. Maybe you can get out from it. Some banks will oversee it a little bit, but still could be harmful for the most. And I'll show you another one here. This is the accounts that she or he actually has in collection. Okay, maybe there was a repo here at one point. There's not a lot to clean here, Jerome. She's just missing out some good payments. That's what she's doing.
Yeah, I'll be interested to see her cash flow.
Right.
That would be the first thing in this scenario right here. I would want to see the cash flow to see what she really brings in, net income. And that comes down to how we have families managing the box first. We deal with it on paper first, the reality of what they have coming in from a net income. And we do this all the time. I want to make sure everybody understands. I do this all the time, and it doesn't matter how much you make. And I want to know who's managing the 2 cars. Because if it's somebody else managing the cars, then from there, we tell that client that these cars must come out of your name, right? Because whoever's managing that account is not managing it well. So at that time, I don't care if they're family or anything like that, this car has to go to be traded in. And if the family member has to get a higher interest rate car loan, I'm not sacrificing my credit because it's hurting the family more by them, managing, right? Or helping, or whatever they think they're doing, they're helping somebody else. And I've seen too many people over the last 20-something years ending up, when you're financing a car for somebody else, majority of the people end up in this situation, majority. Right. Based off of what I see on a daily basis and think we're fixing. Not based off what they read online, John, what we see on a daily basis.
All right, so I'm running out a little bit of time. We're going to a little bit over an hour now, and I really thank for your time here, Jerome. And stick with me just for a little bit more before we can say our goodbyes. But I gotta jump onto something here to speed up. I think, like I said, when it comes to credit, you need to consult somebody. When it comes to money management, consult somebody. Or if you feel like you're capable of doing it all your own, you can. I know you can. All right. But here's a couple of things that I've wrote down for you. These are do's and don'ts. If you're thinking of buying a house, do keep originals or be able to access your employer bank sites, all pay stubs, bank statements, and other important financial documentation. So we run into a lot of times is folks that are not organized with their paperwork. And then when we ask them for a pay stub or a profit and loss or tax returns, they don't know where to find it. And then they are in the mercy of asking someone else. I had one recently where I had a problem with a new construction home. The guy needed a 2020 profit and loss, and the accountant, in the midst of the highest season, accounting season, didn't answer the phone, didn't answer emails, and couldn't give him the profit and loss. You know what I mean? And now the builder's like, you know what? You're not qualifiable if you don't bring me this today. You know what I mean? We have time. Time is of the essence. We want to close in 30 days. You need to get this through. So be organized. Do consult with your loan officer to address any issues, your credit history. So again, like we were saying all this time, do start a savings plan and make sure to deposit all, I misspelled it here, all your cash funds in your personal or savings account at least 3 months prior for applying for a home loan. And I tell you why. I tell you why. The banks are looking at to being able to source your funds. The banks are looking at and being able to have your cash being seasoned. They are afraid that the money you're putting in your account is drug money, okay, or unlegit money that you didn't pay taxes on it. A lot of you make legit money, but you put all the cash under your mattress. If you're thinking of buying a house, financing a house, you got to get that money back in the account, period. You have to put it in there, unless you're not planning to use that. Okay, but so it's important to do it at least 3 months. More the better. The more the better. So it's seasoned in your account, or you're going to have to source where it came from. Maybe you sold your bicycle, you sold a motorcycle, and you receive all cash. Well, then you're going to need to have proof that you had a listing prior to that loan application, and that listing on the web sold, right? So everything needs to be documented when it comes to large deposits in your bank account. So you want to make sure all your cash are in there, okay? Do pay all your bills on time. So that's funny. They're going to question, why are you struggling on making a $25 payment? Sometimes we make mistakes, or our bank account had a hiccup and did not really make that quick pay that you asked to do, or maybe you just forgot about it. That happens to everyone. I know it happens to me as well. But you want to always pay your bills on time. Do communicate with your loan officer about any recent life changes. Well, so here's what it's important for you, okay, to know. Consult your loan officer if you're going to about to change jobs or change careers. It's very important. The banks are looking for somebody that it has a stable job. If you just started a new career and you're self-employed and you don't have 1 or 2 years to show for it, that's a problem. We don't know if you're going to do well the next year or so. Okay, if you just started a new job and it's not the same industry that you were before, that's a problem. We don't know if you're going to do well with that new job. We want to see that you have experience in what you're doing. Okay, so communicate with your officer if you're thinking about changing your job just before you're buying a house. We're going to strategize this thing for you. Sometimes it may be an idea for you to stay in that current job before you move to the new one, at least until a few weeks after you have the keys of your home in your hands. Forgive me. Do provide your earnest money deposit from your own personal bank account or acceptable gift funds. Okay, so your deposit, your earnest money that you give to a contract, as an offer to write a contract, execute a contract of purchase, that money needs to come from your own account. And you need to, again, be able to source it, and that money needs to be seasoned unless you can prove that is a gift. Okay, now the do nots are the most important ones, to be honest with you. Do not close or open asset accounts or transfer funds between accounts. That's crazy, because if you do that, they're going to ask for bank accounts on every account you transferred money from. I'm serious. So if you have let's say 4 accounts and you're always constantly transferring money from one to the other, now you need to source where your money is coming. Well, guess what? You're going to have to show all 4 bank accounts. All right. Do not deposit any monies outside of your payroll deposits. Again, back on the cash, because if you deposit 500 or higher, that is just straight up cash, you're going to have to show, if you're just apply for a loan and you need the last 2 months bank statements, and in that bank statement you see a $1,000 deposit, you need to show where that came from. Okay, I'm telling you right now, you're going to have to show it where it came from. So be prepared for that. Do not change jobs, employer, without inquiring about the impact this change might have on your loan. So again, contact your loan officer to ask how to strategize that scenario. Do not make any major purchases. That's the number one loan killer right there. Oh, I just got, you're talking to a friend, or I just bought a house. I had a great realtor, a great loan officer, and I just bought a house. I'm under contract. I haven't closed it yet. And you know what? I can't wait to go to home rooms to go and buy new furniture. And then they go there and finance new furniture. By the way, that's going to show up. The lenders are going to pull your credit just before you close again to find out you haven't incurred any new debt. And you just killed your loan right there. One day before you get your keys, you killed your loan because you got a new car, or you financed a home, or you bought appliances for the new home that you're about to buy. No, no, wait for it. If you're thinking about buying your home, you need to make sure that every move you make is about the home, but not, but stop any new financing. Stop. Do not incur any more debt. Do not use your credit cards anymore. I mean, you have to put every financial move in a halt and focus on buying your house, okay? In other words, making more money for you to afford that house is important, okay? Do not open or increase any liabilities. Again, the same point, including credit cards, student loans, or other lines of credit during the loan process, as it may impact your qualifying for the loan amount. So it might not kill your loan, um, but it might make you put more money into it, because you can no longer finance due to DTI limits. You cannot longer finance that same loan amount because you incurred more debt through liabilities or credit cards, that your minimum payment went up. Then now again, your loan was 200,000, now it's 195. Then you have to come up with more money, right? Do not consolidate debt. That's kind of weird, because consolidating debt, you may think that is going to work for you, but sometimes it doesn't, because the interest on these consolidation companies are a little higher. Now you're putting interest on a higher volume, so that minimum payment becomes a lot higher. So before you consolidate that, you consult your loan officer as well. Okay. Okay, but now let me step back here a little bit. This is important for everybody to understand. Again, I want to make Jerome a buyer out of this program, okay? And that's what we're here for. And I'm going to ask you a question, Jerome. Very, very, very important. I'm going to step back here a little bit. I know this is taking a long time for some of you, but if you're thinking of buying a home, you're going to stick around, right? Okay. Jerome, do you need money? Do you need money to buy a house nowadays? Do you need to have reserves in your bank account to buy a house? Jerome, I lost your mic.
Yeah, can you hear
There you
me
go.
now?
Yeah.
Okay.
Do you need
So a
money to buy a house?
misconception, you need a little money, but there's strategies out there where it's going to open up more questions. You don't need a lot of money to buy a house. You might need your earnest money, and then you get professionals like us to structure the right loan program and negotiate where you can buy a house, total cost out of pocket, and you can can't put the earnest money strategies. But to answer your question directly, you don't need a lot of money.
Not a lot of money. Not a lot of money at all, guys. And we have products, all sorts of products, and there are down payment assistance grants available in most counties and states out there. If you don't know about down payment assistance, consult your loan officer and your realtor. If they don't know about down payment assistance and you need one, you need to find somebody that understands. There's a lot of agents out there that do not know about down payment assistance programs or
Don't
grants
know.
that are available. A lot of them, a lot. There's more people that don't know than there is that know. Okay. So and this is free money, guys. Free money that there are nonprofit organizations out there. Their sole purpose is to put more people into homes. Okay, just like me and Jerome here, more people into homes is our goal. So down payment assistance are available in almost every single state, every single county. It does change from one state to county. Okay, so they're not all the same. So that you need to realize that they're not available for a lot of people. They're mainly there are income limits. They're really to support somebody that makes less than a certain amount of money. Okay, they're not available for somebody that doesn't need down payment assistance, basically. Okay, so so they're there to help
Yeah,
you get into it.
and John, right, not to cut you off, so let's make it clear. When we're talking about a grant, right, that's for, there's stipulations on the grant, right? But on the loan, they may not have an income limit on the loan. So even that person has a lot of money. I want to make sure I'm clear. When we say, when we're helping families, we're structuring the deal for a person that doesn't have a lot of money, but we have a lot of clients that have a lot of money and they choose not to put a large down payment on a house. So, and you don't have to be a first time home buyer in a lot of these cases. So let me give you two examples this week. Tomorrow, we have a client closing on a $325,000. The total cost out of pocket is they had to put their earnest money down of $3,000. They're getting it back at closing, right? That's because they're dealing with experts that have been doing this for a long. Have to put 5%, 10%, or 20% down. They didn't get a grant, but they did get a 100% loan, like a VA loan. I said like, but not a VA loan, and did not have income restrictions. But that formula comes from dealing with a professional like John on the financing side, dealing with a person that knows how to negotiate, which we both know how to do to make that happen. I have another client that's closing on Friday, buying a house $1,000. Again, he's not utilizing a VA loan. You notice I'm saying I'm being very specific. So he's coming out of total cost out of pocket somewhere around 10 pay some of his closing costs, but he did not put a down payment down. That's to give you the confidence why we came on that show. There's more than one way to help a family. That's why John is putting these calls on. John knows a lot about all the different programs out there. He's well versed in that. And so I don't want nobody leaving this call thinking, oh, it's only for people that have this income caps. Yes, the program John's talking about right now has income caps all through the state of Texas, but he has other programs and the knowledge to get you, and you can have a lot of money. You can have 50, 60,000, but you should go to John because he knows where to go. So you don't have to use all that money and give you
So you
options
don't.
and strategy. He's the professional, but I
Yes.
want to make sure I took the time to explain that to people, John.
Yeah, I appreciate that, Jerome. And look, this show here is not all about just me and Jerome and what we can do for you. There are people in your local community, in your local market that will have the same knowledge.
Right.
And I mean, and it just takes a little bit of research for you to find. And like Jerome said, sometimes it's not about whether you have money in your bank account or you don't have money in your bank account. If you do have bank money in your bank account, but you rather not use that money because you have other plans for your family, or you're thinking about renovating your home, or you're sending your kids to college, there are solutions where you
Yeah.
can come out without spending any of that money and utilizing the programs available out there. And then right now, these are the type of programs that we use to finance a home these days, right? So conventional,
Mhm.
FHA, USDA, the VA, and the jumbo, and the non-QM. Okay, I'm not going to go around and read every one of these paragraphs. If you would like for me to share this table here of information with you, you just leave me a quick note, send me an email, and I'll share to you the differences between these programs. But I wanted to touch base in a couple of things. Okay, the conventional The conventional loans are typically your vanilla mortgages, the ones that have low debt to income. They have the proper documentation, W-2s, and make enough income to qualify for a loan. They do have to come up with more money down payment on that, but then again, down payment assistances and other programs and negotiation factors can come in and 5% off the table from you, right? Now, the FHA products are more of the insured product out there, and it's the most common product used. And I'll give you a quick example between the two. You know, conventional products are more concerned about the quality of borrower you are. Okay, the stronger the buyer, the stronger the borrower you are, you're likely to use conventional loans. And an FHA is more, they take a little bit more risk in the quality of borrower that you are. And then they are more concerned in the home that you're purchasing. Okay. And then you have SDA for homes that are in the rural sector, and then VA for our veterans. And thank you for your service, veterans. There are products available for you, and there are pros and cons on all of these products here. But I wanted to get to the non-QM, the non-qualifiable mortgages. These are mortgages, they fall in outside of the qualifications of a conventional, an FHA, USDA, or VA, or even a jumbo. They fall off, meaning you don't have W-2s, you don't have tax returns because you haven't filed yet. These are the type of products that are going to allow you to use bank statements to purchase a home. So again, there is a product for every single buyer out there. And a lot of times, if you are talking to a loan officer and he doesn't have a solution for you, don't quit. Don't think that that is the only answer that you're going to get. Sometimes another individual like ourselves can come in and look at it in a different aspect and be able to find the right product that will qualify you. Okay. So again, do not give up too easy, because maybe sometimes one agent don't have access to all these products or doesn't have the knowledge another one do. Okay. Um, Let me make sure I'm not sharing something too soon here. Hold on. All right. Okay. So, all right. So on bank statement programs, this is slowly coming back. You know, Jerome, after 2009 and the recession and Dodd-Frank, they pressed a lot of brakes with financing. They took a lot of the programs out there that were being abused. The stated income was very abused. But slowly they're coming back, and now they have banks that are now willing to take a little bit more risk. So now we have the bank statement program. This is created for self-employed borrowers to purchase or refinance. Since tax returns are not required, this could be a great option for credit-worthy self-employed home buyers. So, sometimes you have everything but the proper documentation for your income, or sometimes you have the income and you just don't have the credit. It's a balance that we have to create here and there. But just to show you, there are variations of products that will be adaptable to your current situation. In this case here, this product can go up to 90% LTV, which means that you have to only come up with about 10% down payment. Your credit score needs to start above 640. 4 years seasoning for foreclosure. So you could have a foreclosure in your history. All you need to be is put that 4 years ago, right? Short sale or bankruptcies, and no tax returns are required. The loans can go up to $3 million. So this will work greatly for a lot of the ocean view condos, or this will work great for Florida properties where you're already in that $3 million bracket. Here in Houston, we go 1.2, 2 million more or less, but we're usually at the 700, 800 mark. on the higher ends. But this product is also good, really, for the 200s and 300,000s and 400,000s. The limit is 3 million. Okay, 2 year self-employment requirement. So in other words, you need to prove that you have been in the same industry, self-employed for 2 years. And who's going to take most advantage of this product here? It's going to be self-employed people. Okay, people that don't have the W-2 and the pay stubs, basically. 1099 option is available. So if you show your bank statements and then you show your 1099, I think you get a little discount on your rate showing your 1099. Okay. Now there are products where you go with just your 1099. And one thing that's important to know, though, while you have products like this, and it's really meant for those that can't get it any other way, um, the interest rates are slightly higher because of it. Okay. And obviously, if you were to just go 1099, that product is going to be a little bit higher as well. It's available at 40-year fixed rate. How crazy is that? 40 years fixed. Interest only is available. So if it is an investment property, perhaps it's likely to require more of a down payment, but it's available where you can finance at a 40-year time period and you're only paying interest and you're relying on that cash flow income and the equity that you're gaining in the property, but not so much paying the principal. But a lot of these products don't have prepaid penalty. And then you're able to just pay the balance or the principal as you go. Okay. So, but your obligation is interest only. Okay. Um, now, here's another one, guys. Here's another one. Investor cash flow. Jerome, you haven't been using this, I don't think so, too much. And this is something for you to know. If you end up working, I know you work with the people a lot more than investors. I know this. Am I wrong? You correct me if I'm wrong.
No, you're correct, but we've been getting a lot of call on investor side because we help a lot of these investors move their
Absolutely.
property. But I like this. I like that last product too. For especially self-employed, great advantage. That's a great product, and I want to know more about the investor cash flow product.
Yep, there you go. The investor cash flow product, Jerome. I tell you this, these are people that don't have. Let's picture this. Let's say that you are in your 50s or 55s, and you retired early because you had a long career with a particular company, and you have your 401k savings you don't want to touch yet, right? Because it's too soon, perhaps,
Mhm.
and you don't want to pay taxes on it. And let's say you don't have any income yet, other than maybe a small pension. Nowadays, companies are not giving pension anymore, right? So you're still not
Okay.
retired and you don't have a social security income. But through your life, you have been able to purchase a few homes for yourself. And now this is your true cash flow, it's your income. So you have a home or multiple homes that generate income for you. Okay. Um, so basically, if let's say one day you wanted to cash out or refinance homes or get money out of these homes, you can use your investor cash flow. And this product will allow you to use the income from the homes only, okay, without you needing to be employed. Okay, you don't need to have an employment, but it will use the cash flow of your existing homes to be able to give you money. Now, in other scenario, is let's just say you're now trying to begin investing in homes and you found an opportunity to buy, let's say, 3 or 4 homes that are all rented. You're buying it from another investor it wants to liquidate, and he's selling you these
Mhm.
homes and they're all rented. They have contracts for like 6 7 months, and where you can guarantee an income flow from these homes. You don't have any employment. Okay, you're not employed, and you're now in the business of um, just managing properties. Okay, so what you do is you get an investor cash flow loan to purchase these 3 homes or 1 or 3. Here says no limit of total number of properties. You see that, Jerome? No limit of total number of properties. So if you want to pick up somebody else's portfolio, It's a great example here. There are a lot of people cashing
Yeah.
out and liquidating right now, and they have a portfolio. They have 5 or 6 homes. You find that package, which it's a bundle, right? And we find it all the time. Last year, I sold a
Right.
bundle. Okay, last year I sold a bundle, and
Okay.
and you find this bundle, you don't have any income, but you get an investor cash flow. The bank is going to rely on the existing cash flow that those properties are being generated. Look at that. You do have to have a good credit score. All right. You do need to have some
Right.
money saved. Okay. Um, no personal income is necessary. No employment is needed. And you can go up to 80%. All right. So this kind of things that are available for investors out there or new investors. Okay. So whether you want to begin as an investor or create more cash flow as an existing investor, or liquidate some of your equity, you can use
Mhm.
this investor cash flow product. And now I'd like to show you something. This is quite special. Our friends with TDECU, this is a credit union here in Texas. We have a partnership with, actually, Jerome was the one that pointed us to the right direction on this particular partnership. They're now issuing us clients that, tell me a little bit about Jerome. You know more than I do in this, man, to be honest with you. It's not even from my mortgage company, but you know what? I'm in it for everybody that can use this product here and just being able to get 100% financing. Tell me a little bit about it.
Right. So if they use you as on the real estate side, John, they're going to get a 1% up to $5,000. So if they, for example, if they want to buy a house for $500,000, they can get a 1% towards their closing costs up to $5,000. Minimum credit score is 660 is the minimum FICO score, and we use the tool in so many different ways. There's no income cap. As long as that client has a FICO score of 660, they can get 100% conventional loan where they don't have to put a down payment down. And because of the partnership we have, there's other strategies that can be used that John can structure that deal. And like the deal tomorrow, that person's getting their earnest money back is because
You have too much credit
we know how to structure the deal to benefit the client. So say it again.
because they had too much
By using the
credit.
credit and other
Yeah.
credit. Right. And so those are the things structuring the deal. But this is an awesome product. It helps a lot of families. And again, I want to emphasize that a lot of the clients have the money. They were willing to put the 20% down. This is just another tool that John offers that for his clients that he can use to lower your expenses. And like you said, John, a lot of kids are going to college, right? Just graduated. So a lot of people having reserves of home ownership because they don't know how much money they got to spend for their kids to go to college. And I can't tell you how many consultations we've done in reference to money to help that family bring less out of pocket and still have, hit their goals with home ownership.
Absolutely. And so they're partnering with a few real estate companies out there. We're one of them, Around Town Properties. And if you're interested and you're in our local area and you want to be part of this program here, and you want to take advantage of it, contact one of us, Around Town Properties. I'm going to have Jerome share with you in a little bit his contact information as well, where we can definitely assist you. We'll take all your calls. Absolutely. That's one thing that I know me and Jerome share is that if you call us, we will answer. If we don't, we'll call you right back. That's it. You're not going to be hunting us. We're there always for you. Okay. Oh, I wanted to share something with you here real quick. And it's besides, let me share another screen with you. Hold on. One second. And this is something pretty new that's came out there, guys. Okay. It's called the thinktrio.com, that we're all pretty excited about. And there's not too much that I can speak about right now, to be honest with you, because honestly, Jerome, I don't know. I heard something about having some limitation of marketing and all that jazz. But since I'm just literally showing their website, I guess they'll leave me alone on this. But there are some things that I can't market. I don't know why, and I've still got to figure it out. This just came in our laps here a couple of weeks back. Basically, it's a company that is there to bridge the gap. If you can't, picture this, guys, picture this. So let's just say you have a relocation situation where you're coming from another state. You don't want to go ahead and just buy it right away. You want to kind of learn a little bit about that new city, figure out where you want to live. But renting is really not quite the scenario for you. You want to have a little bit more control where they're going to live, and use a program that's going to benefit you the most. You can think Trio. Um, and then let's just say you were just graduated from college. You have a little bit of a steady income, or you were part time. You're about now to go to full time, and let's just say you don't have a lot of credit yet. Okay, you can think Trio. Let's just say you just went through a divorce and your credit is a little bit shot because some of these bills weren't paid. Your scores dropped, but you don't want to rent. You want to still purchase your home. You can think Trio. And I'll give you a little bit about what we know so far about this product. Okay, so it is not so much for those that have credit issues. It is for everybody, and I'll tell you what it is. This is an investor who have a partnership with HUD, and they were actually it's going to be a FHA product, and this FHA product is going to purchase the home for you, go into a or for the investor, but you're going in with a lease agreement with that investor. So basically, this is your true rent to own product out there, where, and again, forgive me for not knowing too much yet about it. And I want to be very careful what I'm sharing with you. Okay. But this product itself is there, what they say, bridge the gap. For those that can't buy it right now, Trio, if you qualify with Trio, they will purchase the home for you. You will lease it from them for up to 5 years, from 3 to 5 years. Okay. And they're going to sign a coach that's going to coach you for 24 months to get your credit into where it needs to be, to get your where it needs to be, to get your life to where it needs to be, where you can simply assume the loan afterwards. So it's quite incredible. A product out there that wasn't available. It's not available in a lot of states yet, but slowly they're growing and going through different states. So they're now available in Texas. I'm not sure about Florida yet, but they're very simple. For you to qualify for Trio, you need to work with a certified loan originator. You need to work with a certified real estate agent through their program to be able to assist that Trio customer and help them. You know, if they're unable to purchase a home through to the normal methods of purchasing a home, the conforming, the FHA loans, or even the non-QM products, Trio will assist you. There is that last home run we can throw and get you in your own home. Basically, they're going to qualify and buy the home of your choosing. Okay, and you're just going to rent to own this property. You're going to rent from them until you're able to assume that loan or buy the home back. But here's the caveat for those that are relocating from another state. If in 3 years' time, this home is really not for you, you can get out from that home. You're not stuck in this house at all. So it is great for relocation. It's great for somebody that just want to test out the house. Let's say you just want to test the house out. You know what I mean? Hey, like buying a car, you drive it for 3 months to see if that car is for you or not, and return it. What if you could do that, right? So I am seeing I'm seeing a great success in different states. It's just now recent here in Houston. I know I have all our agents excited about. I know Jerome is quite excited. We all went through the certification process already. And so if you're looking for an alternative to rent to own, which in this state here, this really is the best method. Forget about owner financing, guys. Owner financing is a seller that's trying to, put you on a very harsh term with financing through that to that individual. Okay, so Trio steps up and gives you a better opportunity. Your payments are not going to be any less than your mortgage payments would have been, and it's not going to be any higher, or if higher, just a little bit. Okay, and you're going to be in a home that is going to eventually give you the gift of equity, and that is something we like to share with you in more details. So please reach out to us whenever you have a chance to see if it's available in your state, in your county, and we would very much love to talk to you about it. But in the meantime, if you want to know a little bit more about it, you can log into thinktrio.com and then reach out to us if you're interested. We'll guide you through the whole process. Okay, guys? Give me 1 second here. Anything you'd like to add on that, Jerome?
No, it's an awesome product. I'm excited about it. People can go to the website and watch the videos.
Very good. And Jerome, do me a big favor here. I'm just going to, I don't know if you guys can see me. I'm no longer sharing a screen, right, Jerome? I think you can see me, right, at this
No,
point? You
I
can
can
see
see
me.
you. Yeah,
You can see me. No share screen. Okay. Well, so I wanted to,
no sharing.
no sharing, right? Okay, good. I'm
Say
not
it again,
sharing it.
John.
I'm not sharing.
You're not sharing.
Okay, good, good,
No.
good, good. All right. Okay, so I wanted to do it in every episode, every podcast we do. I want to do the book of the day. Of course, I'm a little bit biased. I want to show the book of the day today is my brother-in-law's. He's actually the owner of Around Town Property. He's one that makes us what we are, our great mentor for many years. And he wrote this book
Yes.
called Rising in America. And this is great for those of you that whether you came from another country like him or you're just starting in the world right now of business, this is going to give you a good guidance and it show you what it takes for you to make it in America. Okay, it's a great book. It's not a very large read. It's a short read, but it's smooth. It's to the point, and it gives you an idea to what is going on in the great mind, the mind that has a ton of success here in the greater Houston area. And I think you should go on Amazon and go ahead and order this book. It's not very expensive. It's easy for you to have. You can get the audiobook, I think, or the hard copy. Either one of the two is great for you. And guys, there is a dedication for me here somewhere, so I'm a little bit proud of the book itself. But give it a try. And last but not least, guys, I have a little bit of sad news to share, and I want to make this really, I want to make this the last segment here as an appreciation for my grandmother. She passed away last night, 89 years old. Lived a great life. She has been my rock my entire life. I think the guidance that she's gave me, a great example of being a great wife, a great woman, a great citizen. Oh my God, I've already cried a whole lot this morning. You probably couldn't tell, or maybe you did, but this was. I'm going to make today, and I'm going to make it in love and memory of my grandmother Dinora. Okay, guys, thank you so much for showing up to this show today. Jerome, I got to ask you, how can they find you here in the greater Houston area?
You can reach me on my cell phone, 281-220-9960. 9960. Thank you so much, John, for having me on the show. Condolences to the family. And
you.
thank you so much again.
I appreciate it so much. So this is it, guys, for today's talk show. And I hope you guys enjoyed the information we give you. And I hope you guys took some notes down. I'm here to show, I wanted to show you that, there is a light at the end of the tunnel if you can't purchase a home. And even if you can and you appreciate, even if you can buy a house and you can, and you appreciate what we're doing here for our communities all across the country, really, please give us a shout. We love to hear from you as well. And thank you once again, Jerome, for showing up in this very long
Yeah.
show we had today. And hope to see you again next Wednesday with our real estate talk show. Thank you, Jerome. Appreciate it. Thank you, everybody. Have a wonderful day.
Thank you so much. Have a wonderful day. Thank you.
That's right.